Hey, this is Justin with daytradethemarkets.com, and I wanted to talk a bit about managing profitable trades, trade management. So often we get caught up in just talking about trade entry, and that's what most traders want to think about, and that's kind of the sexy thing. But the true difference between making decent money and really good money, or breaking even and making money, is in how you manage your exit decisions. And so that's something that, just as an aside, with this Day Trade the Market software, I have found to be one of the greatest benefits that we have is simply using it for exit management. We actually hear this a lot from people, where people may have a method they're already using, but they simply use our software to help manage their exits a little bit better, and they find they can hold winning trades a lot longer than otherwise they did. And that's a great way to use it. You don't have to use this for entry. Again, you could, like I said, a lot of people just use it for exit management, and that works out great. So what I wanted to talk about today was different ways of determining when to get out of profitable trades. Okay, so the way that I like to look at it is I want to first ask this is just my opinion. This is Monday, May 12th, but this would apply to any day. The date's irrelevant. And the market's still moving. It's about 1:45 Eastern time, but it's been pretty quiet for a few hours here. So I thought it would just take some time to look at this question. So anyway, the questions I like to ask myself when I'm in a trade, I like to ask myself two questions first of all, and they are: what is the quality of the trade opportunity, and what is the bigger picture market context? Those kind of run together. But basically what I'm trying to do is I'm trying to, at least in my mind, determine whether I really have a lot going for me with this trade, if I'm in line with the bigger picture bias so that I know I'm kind of swimming with the current, if you will, or if I need to be a little more nimble, because I think that's the first question you need to ask. And you need to, rather than, trading is certainly not a black and white endeavor, and no two trades are exactly the same. So you want to always try to put your trades in context, and that's one of the big things that we try to talk about and teach all the time. Just like if you were playing golf, not every 100-yard shot is the same. Sometimes you'll play it high, sometimes you'll run it in, sometimes you have to play the wind, the course conditions, whatever the case. And it's the same thing in trading. So you always want to try to put the market in context. Now today I'm looking at the ES with a 1-minute chart, and we've got a couple things context-wise. First of all, our bigger picture bias, and this is something that we look at in our member report every night, is definitely up, and it's pretty strongly up. Also, we had a gap up today. In fact, we had a really strong rally right before the market opened. Here is the pre-market rally. So you can see that right around, this is about 6:30 Eastern time. This is a 3-minute chart, by the way, which is what I like to look at for the overnight market. We had this high velocity move higher, and then right before the open, we had a level 3 buying aggression bar. So it's showing us a lot of strength right before the regular trading hours open. And so then we continued to get some really good strength on the first bar of the day, which was another level 3 buying aggression bar. So that certainly is a really nice buying opportunity right here. Just as an aside, this is the idea of confluence here, where we've got we know that buying at the low of level 3 buying aggression bars, like here's another one right here, is a very good entry. We've also got here, we've got a support zone, this green zone. Our filter's green. Our bigger picture bias is up. So there's a lot going for this trade if you just, for example, got in right here. But whether you got in right here, whether you got in at the bottom of this level 3 bar there, or whether you got in using a completely different entry methodology, doesn't really matter. For the sake of this video, I'm just going to talk about, let's say that we got in right here, okay? Or even right here, doesn't really matter. So the first question is, what's the quality of the opportunity? Well, it's pretty good because our bigger picture bias is up. We had a big rally right before the open. So all signs are pointing to this being a pretty good spot to be in the market and a pretty good opportunity. We're swimming with the current of the market. So in my mind, I'm looking to, the way I look at it is, if I have a lot lining up, I'm looking for I'm looking for every reason to stay in the market. So I want the market personally to prove to me that I should get out, as opposed to the other way around. If I need to be more nimble, for example, then I want the market to prove to me that I should stay in, and I'm looking for a way to get out. So hopefully that makes sense. But the idea is, put the market in context. If you feel like you have a good opportunity, which being long today to me is a very good opportunity. So then, again, let's just say for the sake of example, we get long right in here. The way I look at it is, you have 3 basic options for profit taking on trades. One is just to have a predefined target, and that may be just a systematic way that you manage trades. It may be simply looking at the next bigger picture level of support or resistance, and in this case we had a level here around 85.75 right here, another level up here around 90.50 right there. So that could be one way to do it. So you just have a predefined target and you lock it in right there, or you lock it in right there, okay? That's one way to go. Or you can put it that, you can go for that and just see if you need to adjust it ahead of time. That's one way to go. The second way, that would be number one. Number two would be more of a trailing stop mechanism, okay? And in this case, what that would be was, I would typically, this is an ES 1 minute chart, you'd have to adjust a little bit for different markets, but the same logic would apply. But the idea here would be that every time you get a level 2 or a level 3 buying aggression bar, you would simply raise your stop to 2 ticks below that. So if we got in there, this level 2 bar comes in, so we'd put a stop 2 ticks below that. Here comes a level 3 bar right up here. We would then put our stop 2 ticks below that. Almost got nicked on this bar. Here's another bar. It wouldn't actually cause us to raise our stop. And then we would just keep holding it. And then you could also do the same thing with any level 2 or level 3 selling bars in this case. So here's a level 2 selling aggression bar. You could put your stop in 2 ticks below that. There you go. You get stopped out right there. Okay, that's the trailing stop mechanism. That would be number 2, and that's a pretty good way to go. I think that works out very well. The other way to go, and this would only be something you would use if you really feel like the market's really in your favor, which again I would look at it today is what I call the proof method. So I'm looking for a reason to stay in the market until the market proves to me that I shouldn't be. And there's a few ways you can define this. The way I look at this is I want to stay in the market until the market proves that some selling is actually coming in. Again, if I'm long, and we're just assuming that we got long in here or in here, but we got long today, just for the sake of example in this video. Okay, so in this case, you can see we're long here, right in here. There's absolutely no selling of any import. There's a few level 1 bars here, but no level 2 or higher selling bars until we get to this bar right there. Okay, this dark red bar. So by proof, what I'm looking for is some kind of selling to come in, level 2 or higher. So here's a level 2 selling aggression bar showing us some strong selling, which is not surprising. It's our second test of the high. We couldn't bust through it. And so what then I'm looking for is not just a trailing stop, but I'm looking for at least a full bar, sometimes 2 full bars below the low of that bar. So here's the low of that bar. And by full bar, I mean a bar that's not even touching the low of that bar. For example, this bar would be a full bar. Now, this happens to be another selling bar, so that's another decent reason to get out of the trade. So right in this area here would be, to me, what I would call the proof method, where you've seen some selling and you've seen a little actual follow through from that selling. So that's kind of the third option that I tend to like to look at. So hopefully that makes sense. That's the 3 methods. So again, I'm looking at the 2 questions I like to ask is what's the context and what's the opportunity, the quality. Today, to me, being long is a good quality opportunity based on the bigger picture and based on the pre-market and based on what we saw with the evidence right at the open. And then to me, in that sort of a situation, I would tend to defer toward the proof method as opposed to the target, the predefined target, or the trailing stop, because I'm looking for every possible reason to stay into the market. Now this, I'm just looking at here at the same type of an idea would apply no matter what market. Here is let me make this a little bigger. Here is a Russell chart. Now I like to look at the Russell on a 2 minute, but the same idea, the same concept applies. Okay, we had a gap up. We had some really strong buying off the open. So if you're long in there, you've got a predefined target is one way. You could do a trailing stop, or you could wait for some follow through, some true proof that selling has stopped, that is selling has come in. So there's a selling aggression bar. We get some follow through right about in there. So the same idea would apply no matter what market you're trading. You just want to put things in context, and then you want to see what the market's telling you. So hopefully that helps. You can use that, whether you maybe you can use that in your own method. Maybe if you're using this software, you can apply that. Maybe if you're using another entry method, you could add this idea to that method. And I think in most cases, it's going to greatly improve the profitability, especially on some of those winning trades. So let us know if you have any questions about that, and we'll talk soon. Thanks.